So in the last video, we used CVP to calculate the break-even point and target profit amounts. In this video, we're going to use the same company and we're going to look at some what-if scenarios. So let's go ahead and turn to the spreadsheet. You can see that on the spreadsheet we have XYZ company's contribution margin income statement, just like we used in the first video. Units sold are back to 13,500, which reflects the actual activity in 2014. We have our revenue, our variable costs, contribution margin, fixed costs, and operating income. In columns H through K, I have the elements of the CVP equation. I have contribution margin per unit, units sold, fixed cost, and operating income across the top. Notice that I've taken the contribution margin per unit of 75 from the contribution margin income statement. Units sold 13,500. The fixed cost 750,000. If we go into cell K2 and look at the formula, you can see that I am taking the contribution margin per unit times the units sold minus the fixed cost. That is the CVP equation, and it gives us the same net income as the contribution margin income statement does. So you could consider this to be a very short way of looking at or doing a contribution margin income statement. I'm going to go ahead and hide these columns, and we'll just work with this table. We want to get into doing some what-if scenarios, and notice that I have called this the base scenario. This is the scenario that we're going to go back to each time, because this is what really happened. So we're going to look at our manager's ideas and look at them in comparison to what really happened. The first idea is that the sales manager comes in and says, let's increase our advertising by $25,000, and that should increase sales by 5,000 units. Okay, let's see if that's true. Now, first of all, does this idea affect our contribution margin per unit? She's not suggesting that we increase advertising by a certain amount per unit. She's suggesting that we increase advertising by a flat amount. So that's a fixed cost, not a variable cost. And this isn't going to change our revenue at all. So since contribution margin is selling price minus our variable cost, it's not going to change. The units sold should increase by 5,000. So we're going to add this. We're going to add 13,500 plus 5,000 units. That gives us 18,500 units. The fixed costs are going to go up. We're going to take our base amount and we're going to add the $25,000 to the base amount. Okay, so what will be our new operating income? We can just copy this formula down. Contribution margin per unit times units sold minus fixed cost. That gives us $612,500. Is this a good idea? It is a good idea, yes, because we're going to make a lot more money with this scenario than we did last year. There's another way to do this problem, and that is to examine whether the increase in contribution margin covers the increase in fixed cost. So the contribution margin is $75 per unit, and our sales manager thinks that this idea will increase sales by 5,000 units. That means that our contribution margin is going to increase by $375,000. Our fixed costs are going to increase by $25,000. So the difference between those two amounts is an operating income increase of $350,000. Let's see if that is true. We say that we're going to get $612,500 with this scenario, and last year we got $262,500. So if I take the difference between those two numbers, I get $350,000, and that is a gain. So this is a good idea. Let's move on to the second scenario. Our sales manager comes in and says, let's decrease our selling price from $100 to $90. That should increase sales by 5,000 units. Let's examine this scenario. Does it affect our contribution margin per unit? Our contribution margin is our selling price minus our variable cost. If our selling price decreases by $10, then what is that going to do to our contribution margin per unit? It'll decrease it $10. If the selling price decreases $10, this is also going to go down $10. So we're going to go back to the original scenario, and we're going to reduce this contribution margin by $10. The units sold is going to increase 5,000 units. We're going to go back to that original scenario and add 5,000 units. And the fixed costs, how are they going to be affected? They're not. There's nothing in here that says they're going to be affected. So we end up with $750,000. So is this a good idea? Let's go ahead and copy our formula. And it looks like yes, it is also a good idea. This one's a little more difficult to analyze the other way because our increase in contribution margin isn't totally straightforward. We can't just say it's going to be 65 times 5,000 units because we decreased our selling price on all of our units. So we can say that the old contribution margin was 13,500 times 75, and the new contribution margin is 18,500 times 65. And so the increase in contribution margin is $190,000, and there is no increase in fixed costs. So let's see if that is what we have here is $190,000. This is our new, this is our old, and there's the change. It's a change of $190,000. So that is also a good idea. Now you don't have to do the second part of these. I'm just kind of showing you a different way to look at it. What would happen if we combine both ideas? Well, in this case, we'd have a $65 contribution margin. Our sales would increase by 10,000 units. Our fixed costs would increase by $25,000 for the advertising. And let's go ahead and copy that formula again. And so yes, this looks like a good idea. And the change is $490,000. Now you can go ahead and see if you can solve it a different way, see if you can verify that on your own. Another typical scenario is shifting between fixed costs and variable costs. There are a lot of different ways that you can shift fixed costs to variable costs or vice versa. For example, we believe that by purchasing a $1 million piece of equipment with a 5-year life, we can reduce the variable cost of our product by $5 per unit. Let's see how that affects things. If we're going to reduce the variable cost by $5 per unit, what does that do to our contribution margin? Well, the variable cost goes down $5. That means that our contribution margin goes up, so it'll go to 80. The number of units sold isn't going to be affected. We're not talking about changing the number of units sold here at all, so that'll still be 13,500. Now, what about fixed cost? We don't want to just add $1 million to our fixed cost because we don't expense equipment when we purchase it. Instead, we capitalize it. It goes onto the balance sheet as an asset, and then we depreciate it. $1 million worth of equipment depreciated over 5 years is $200,000 per year. So let's go ahead and increase our fixed cost by $200,000. And then we can copy the equation down, and this looks like a bad idea. It looks like if we do this idea, we're actually going to lose $132,500 per year. Again, we can verify this by saying that our change in contribution margin is $5, right? We're going to make an extra $5 per unit times $13,500, and our increase in cost is $200,000 a year. And so there is our $132,500 difference. Would it matter if this equipment could be amortized over, say, 8 years? So we could go in and we could check that. We're still going to have 80. We're still going to have 13,500. But now we have $1 million divided by 8 years is 125,000. We're going to add 125,000, and it's still not going to work for us. We're going to lose still 57,500. So we're going to go ahead and tell our manager that no, this is not something we're going to do. We can also decrease fixed cost by increasing variable cost. An example of this is eliminating sales salaries or reducing sales salaries and giving the salespeople a commission. That increases the variable cost. So let's take a look at this scenario. How much does it affect our contribution margin per unit by? Well, if sales is $100 and we're going to give a 10% commission on each unit, that means our variable cost will increase by $10. That means that our contribution margin per unit decreases by $10. So the new contribution margin per unit is 65. It doesn't say anything about changing the number of units sold. And then our fixed costs are going to go down by 125,000. So let's go ahead and copy this formula. It's not a good idea because if we do this, we're going to lose $10,000. The salespeople might be very enthusiastic about getting a commission instead, and so they may want to try to convince you that they can sell more units. Let's say that they go back and argue that they can increase sales by 10% if they are paid on a commission. So in this case, we're not going to go back to the original scenario. We're going to use the same scenario as we had above. $65 will be the contribution margin, but our units sold are going to increase by 10%. So we're going to take them times 1.10 or 110%. And the fixed costs will be the same as they were. And let's go ahead and copy that formula. And now it looks like that is a good idea. So we might tell the salespeople, well, I'll tell you what, we're going to try this and see if it works. And if you really can increase sales by 10%, then we'll go ahead and leave the commissions in place. Otherwise, we need to go back to the old arrangement. This concludes this video. The next video will add taxes to the equation.